ladies and gentlemen. Welcome to today's webinar. It's Friday, December the 30th. Now we're entering in our last webinar for this month, for the year. And of course, we are looking at a few additional advanced strategies for the first quarter of 2017. Well, ladies and gentlemen, what we saw so far during this month's webinars, we saw very interesting facts about the Brexit, the European Central Bank, the Federal Reserve, and of course a few minor things about Bank of Japan, also Brazil and other parts of the world. We've been closely discussing the Federal Reserve's interest rate hike. This is something on what we're going to be focusing on, as it's one of the biggest, let's say, it's actually the biggest economy in the world. So that would be pretty much the driving force of the world's economy from the beginning of 2017. Therefore, mostly the markets are focusing on this fact. Of course, other fundamentals throughout the day, the month, or first, second, third, and fourth quarter of the year would be having a different type of impact on the market. However, the initial focus of investors, traders, and other participants in the market environment, of course, would be the type of a rate hike lift during the progress of the new year. Now, given the fact that we have, let's say, been promised by the Federal Reserve to raise interest rates at least 3 times, maybe 4 times during the year of 2017, that would mean that at least each quarter we would have an interest rate hike. Therefore, we should be prepared quarter to quarter with different strategies to be met, of course, to meet the market conditions when the fundamentals are changing. Speaking of this, today I have prepared 2 very simple but of course quite powerful systems that could be aligned with the fundamentals. And the fact that we can't really grab all 2016 as a year in one particular webinar, we would be focusing on the conditions we have seen so far throughout the whole particular month, 12 months of this year, and spread them in the next 3 months of our webinar educations. Therefore, the new month of January, of course, we would focus on pretty much the same topics, of course, with different fundamentals, different technical systems, but all of that you will see with the beginning of the new year. As today is pretty much the last trading day of the year, I'm a bit stressed on to conclude all my deals, to finish all my positions in the next few hours, so I can relax, of course, meet the new calendar year with a peace of mind that I don't have any open positions. Of course, that would be the initial thought of any particular trader when the day began. Therefore, I will rush into it straightforward, start with the first particular trading system that we're going to be talking about today, and I have already set it up on the euro-dollar chart, and I have already marked, as you can see, December 14. That would be the date when the Federal Reserve lifted rates for the second time in the past 10 years. We can see very familiar indicators here. We can see the average directional movement index. We can see the moving average convergence divergence. We can see 2 additional moving averages on the main chart. And of course, most of all, right now we're going to be using the average directional movement index with a period of 14, as you can see here. Firstly, I'm going to try to conserve time because there is another system that I want to talk about, and it will be with the connection of support and resistance and pivot point levels that we've been calculating on our first webinar this month, because it's an initial and very integral part of the actual calculation of how we can position ourselves prior to the expected news and the market direction itself, and of course major points from turnarounds on the market. Therefore, today we're going to be using the directional indices on the ADX as, of course, direction pointers. We can see that once the average directional movement index and their directional indices as the positive and negative directional indices are pointing to a direction to the upside, this is the actual trend that is developing in the stage, or the actual direction. So if the red or the negative directional movement index is pointing up, of course that would be a downside direction on the market. If, of course, vice versa, we see the positive directional index turning to the upside, of course we can see some upward movement on the market. And of course the directional movement index as an index itself, that would be the white line curve, it's actually pointing to the volatility strength and the reliability of the trend itself at the current stage. The quicker it gets to a higher level, the quicker the volatility is exhausted. And this is what we can see. Of course, declines in the volatility or the directional movement index, that would not necessarily mean that the trend is over. It's actually slowly decreasing the volatility of the trend itself. And therefore, we can start looking for exits. However, as we already know how to use that particular indicator, we know that at highest level, at let's say 30 or 40 or 50, it really depends on the system itself. At this stage, we're mostly going to be looking at gradual exit from our initial position, basically partially exit. If you're going to be spreading in on 3 target points, let's say, you're going to take 50% of your initial lots on the first position, half of the rest of the remaining of the position you're going to be taking on the second one, and the final half you're going to be taking on the third one, or you're going to spread 70 to 30 on the second to the final one. It really depends on your preparation and of course on the type of trader that you are. If you're a less risky trader, more conservative, of course you're going to be taking 70% off on the first trade, on the first target, 30%, 15% on the second, and 15 on the last, or 50 to 30, and then to 20, or 40 to 10. It really depends on how you would prefer to take your profits. However, speaking of profits, it's very easy for someone to calculate the potential profit and of course the pip size of any particular position, but when it comes to that, when we are on the verge of something that it's going to happen, and we don't know exactly what is going to happen, but we do have an expectation from our fundamentals and the careful assessment of the market that we've done so far, we're safe to say that we could be able to rely on our technicals to enter a position in the direction that the technicals are pointing according to the fundamentals which are aligned in time, which is December 14. We can see the doji that it's been formed over here. However, our particular case, which happened 4 hours later, I'm pointing to a 4-hour chart because it's much easier to see these particular movements. However, looking from a 1-hour standpoint, we can see that we have to scroll back a little bit so we can get to that point. Of course, the case is pretty much the same, so let me just get back to it. Sorry, I'm going to have to scroll down. There we go. This is where I have marked the 4-hour doji. So from here, the next 4-hour candles were starting to form, and then the crossover occurred on this candle. So this is where we have our directional indices converging, pointing to a further downside. But this is where actually the Federal Reserve raised interest rates, and from then on we have full confidence that the market is going to go down. But what we don't know is how to position ourselves and how to get this case booked in our trading accounts. Now this is 88 pips, or let's say 80 pips or 90 pips. It depends on how you measure it. So this particular case is a pretty good profit to be wasted. We know the expectations of the market. We saw that the volatility have risen to its highest at this point over here, okay? We already saw that the market is standing on a sideways direction. The directional indices have started to converge. The negative one is pointing to the upside, showing downward direction. The positive one is also going down, so showing that the upward direction has already exhausted. We see the MACD here is firmly to the sideways direction, which points to only one direction that it's possible. According to technicals and fundamentals, there is only one way the market could go at this stage, and this is downwards. At least the initial market reaction. So if you're a scalper, and let's say if you go to smaller time frames, this condition have happened for about 5 to 15 minutes. Okay, so if you want to scalp this and just book about $800 to $900 in a lot, that would be your case. However, if I am more conservative trader and I'm looking at a 4-hour chart time frame with the same system, I would be looking for that convergence, which actually happens on these first 4 hours of the trading day. On the event itself. So even if I don't catch that move, but then I have that convergence, and I can see that the directional index is pointing to the upside, and it's above that crucial 20 level here. That's why I pre-made it. 20 is the mark from where we're going upwards or downwards, depending on the trend, but it's actually volatility strength, as you can see, here and here. And it still remains above that 20 level, despite the fact that it's declining. Mostly what we need to know is that it's above that 20 level. If it starts falling below it, we can see that the market here is pretty thin. All that case stands pretty much on the neutral side of the market. But in this type of case, when the market is pointing above that 20 level, we can see that there is a case of about 100 pips. And we're talking about a 4-hour time frame. If you go down to 1 hour, you will see that these candles are much bigger. Anyways, my goal here was to show you how significant the average directional movement index is in particular cases when we need slowing indicators to show us continuous market movements according to aligning fundamentals. In this case, we already have the MACD from here pointing downwards. On the next one, on the crossover here, the crossover of the two moving averages, one of it is 21, the other one is 10. Now I'm using the 10 moving average because on a strong downtrend, it's a very well-performing resistance level. On an uptrend, of course, is a very good support level. So basically, if we're using 14 or something even higher, we would be mistaken, because then we would not have a case like this one when the moving average has been tested but then failed, and before the market actually start reacting to make a divergence, to cross over the faster moving average, crossing the slower one, as the case of this one, we would not be able to exit the market in this stage, which on another hand is about 140 pips in size. So that's 4-hour chart. It works the same way on the 1-hour chart. But this is from 14th of December to 22nd of December. That's about it's about what, 8 days? So that's about 8 trading days. It's a week and a half. So for a week and a half, you're making about 140 pips of profit. That's $1,400 in single lot. I don't have to calculate for you how much that profit would be if you would be trading with 10 lots. That's 14,000. With 100, it's 140,000. So my idea is to show you that how the most simple system, but the most reliable, let's say quite reliable, and on another hand, well tuned, because the particular indicators in this stage are showing the market direction prior to the announcement of a very significant fundamental, like the Federal Reserve's interest rate hike. We have that doji. The market have already started to converge. Of course, we know that the ADX is a delaying indicator. The MACD is a bit more faster. It's pointing to the downside. From here, you can see the curve of the bars of the histogram. Of course, as a conservative type of trader, you would enter from this stage here. Now, you would not be looking at the support levels because you're mostly relying on technical indicators which are showing you a direction. So therefore, we're looking at a downside direction from here to somewhere within those dojis, which of course these are about 4 or 5 sessions. It's about what 16 to 20 hours, something like that. This is one of the ways to exit a position like this one, and this is mostly on the declining indicator of the directional index, which is the negative one in this stage. So when you start seeing these declines, you might be, booking your profits gradually. So if you started here from the opening of this session, because you can see the crossover happened on the previous one, and you're a conservative trader and you want to exit the first one here, that's about 60 pips. Let's say you have one lot, so you have 60 pips of profit, you get half of the lot, that's about $30, 30 pips of profit. You leave the rest of the position down with another 90 to 100 pips. So basically on the second session you book another 38 pips of profit. On the next one you book another 70 pips of profit. All of this you can make gradually. Of course, that would not be the same profit in size, and I mean in money size, because you leave less and less from your initial position. And by calculating this, you would see that it's going to be less in dollars. But in other words, it would be a very good profit if you do it that way, because it's the proper way. However, more risky traders would prefer to see the end of the particular trend, which of course is going to deliver pretty much less pips in size, which would equal the same amount of profit in dollars if you have gradually taken your profits so far. Any case, that's just one case, as we can see here. This case, a week prior to the announcement, we can see pretty much the same case here that actually started from over here down to here. That's another 80 pips of profit. What I'm trying to say is here were the expectations of that Federal Reserve rate hike. A week prior, we saw numerous inflationary data for US, which actually reinforced that particular rate hike. We saw the ADP employment change. We saw the non-farm payrolls, which came out pretty good for the market conditions, which of course we have seen that these conditions are also met and in line with the technicals. Therefore, we can start from here and even exit down there or here with pretty much the same market conditions without suffering losses that we have seen so many times on the market. But these conditions, ladies and gentlemen, are just about a few. Now if I have to go, let me just remember this as a template, for example, and we're going to save it as let's say Q1 2017, just to be easy. Let's have a look at gold prices, for example. There we go. Okay, now this is what we see for gold on December 14. Okay, the trend actually started a week prior, pretty much the same date. Down there, if you can see in the white rectangle, December 8th, pretty much the same time we saw that ADP employment change reports and also the non-farm payrolls. We saw the same case. You can see the trend started over here. We saw that crossover. The market have moved with a volatility that actually increased in time up until 2 days before the announcement of the rate hike. And of course, as usual, that it's pretty much in the characteristics in gold as a metal, it usually retraces almost 66% from that initial fall drop down. Now we can see that 190 pips here. And that retracement was about 80 to 90 pips, so you can see it's about 50 to 66%. From there, the market fell with another 364 pips, or $36. Well, ladies and gentlemen, if we have kept a position after this sideways direction, when the market showed us downward direction, crossover between the moving averages, crossover of the positive and negative directional index movement, we have an increase in volatility in the actual directional movement index. Here, the MACD's histogram is in a negative territory below the zero level, and from here we have a profit of roughly $45 in 28 sessions. So that's about 3 weeks of trading, ladies and gentlemen, and we have about $4,500 of profit in one lot. Well, to trade one lot, you only need about $1,500. So I would say for less than a month, this is 150% of profit. Well, this is only one case, as I said, but the previous case of the euro dollar. Now, what if you have a particular account size that can sustain all of these cases, and you have the time to assess the market carefully to enter these particular cases? Now, I would say that you are not only going to double your account in 1 month, but depending on the initial size of your account, that's not going to be only $4,500, but it could actually be 20 to 30, maybe to 50,000 or $100,000. So this is how a professional trader thinks. You're only thinking in percentages. You don't think about the dollars. You only think about the percentage in return. So if you have $1,500 and you can trade one lot, then 150% of return on that investment in less than a month, that would mean that next month, with the same market conditions but for a different currency pair or a commodity, you could do the same amount, 150% return, but right now your 150% would be the initial $1,500 plus the $4,500 plus the 150%, which would give you about $14,000 in an account in 2 months, and you actually started with $1,500. So this progressive type of increase of your balance would give you the purchasing power at the end of the year to be not only a trader, but to start thinking about some real investment in the long run. Therefore, you're going to start paying attention to longer charts, bigger charts, different systems as a professional trader would do. And that leads me to believe that we have to go to something less complicated, something that could, let's say, be of use to a longer term type of trading, like support and resistance levels, and not only, but the formulas of pivot points, support and resistance 1 and 2 that we spoke on our first webinar this month. I have prepared here, as you can see, those Fibonacci levels, which is one of the ways that you can recognize pivot points, support and resistance levels. It's much faster. As we can see, they apply pretty much because they've been calculated for a longer time frame, because we're looking at a 4-hour chart. Then we're focusing on, let me show you, on a daily chart. Okay, you can see those Fibonacci levels from the trend. They pretty much apply quite accurately. However, my intention here is strictly informational, educational. Now, I'm not going to waste your time on Friday, on the last trading day of the year, with boring calculations as we have done on our first session. So you know the formulas for pivot points, support 1, support 2, resistance 1, resistance 2. All of this we have calculated. You know how to place them on the chart, and you're pretty much going to receive something like this. Okay, numerous support and resistance levels, which could be used in the trading for mid to long term, because all of that would be also aligned with my technicals, or the technicals that you should be using when speaking of support and resistance levels. In this case, we're going to be using 3 individual moving averages. In this case, we're going to use the 14. It's slightly less sensitive when speaking about longer term charts. Also, we're going to use something smaller for much better entries, like the 7 moving average. You can use also the 5 moving average in this case. That would also be suitable. However, I would basically focus on something in the middle. Okay, that's not very recognizable. Let me put a different color here so we can clearly see what we're talking about. So we have lime green, white, and yellow. Yellow is 21. The white remains the 14, which is the mid one, and the smallest is the green, which is 7 in this case. And of course, we have to use our favorite oscillator, which is the relative strength index, and that's our 14. Of course, everything else have to disappear from the chart. And what we've got is a very simple trading system giving us an advantage of overbought and oversold conditions. But as we know, the relative strength index as a singular indicator is also a volatility and volume indicator. And as we mentioned earlier, we need volume for the fundamentals to align. So speaking of which, the same case in gold here, we can see that it actually started way over here, pretty much the same time, 8th of December this year. We can see the crossover of the 3 moving averages. Closer look would lead us to believe that the market have been pricing in, since it did not sustain trading above that resistance level here. Of course, we have numerous support and resistance levels before the actual market started to decline, and it have exhausted its power down to that support level, as you can see. So that's $65. Okay, $6,500 in what, about 8 sessions? That's 8 4-hour time frames. How many times, ladies and gentlemen, have you actually made such an amount for about 2.5 days of trading, or 32 hours, let's say. Well, I'm pretty sure that the confidence in the market that you have is very significant, and the systems that you probably use at this stage are relevant to the current market conditions and the fundamentals. I would actually prefer to think that in the cases when I'm not making money, probably that I'm not doing something wrong, that I'm doing something wrong, and my technicals are not in line with my fundamentals. Therefore, I'm in constant search of something that could help me improve my trading experience. And the same case as we spoke earlier, we saw the market confirming below the 50 area of the relative strength index. We saw the crossover of the 3 moving averages in one point here. Also, the same conditions here, $4,500. Nothing different from what we saw earlier, just 2 different systems, but working in the same way. So the first one might be a bit more easier for you to understand. This one, however, for some traders that are not so familiar with the other more complex technical indicators, could find this one much more appealing to their style of trading. It really depends on what type of trader you are. But in this case, as we mentioned earlier, when the market retraced and we saw some sideways direction just 2 days before the rate hike, on the previous system, we saw some market hesitation, that it could actually flip over or continue downwards if we saw a particular crossover of the negative and positive directional moving indices. We didn't show that. Of course, the market continued downwards. In this case, it's pretty much the same. Moving averages are staying to the downside. We don't have a crossover. We only have a touch of the two smaller moving averages here. A retracement above the 21, not sustained. Market moves down and kept moving further down into oversold conditions around that level of the relative strength index. Most of all, the most important fact here was that the relative strength index is a good volume indicator, that it actually showed that the downward direction could continue without breaking above the 50 level, which is actually crucial at this stage, because we can see here the market is breaking above that 50 level. It's testing the resistance level, which is very important. That's why we need those formulas we spoke earlier, support and resistance levels. And then we saw the minor support here and the major resistance is acting as a channel before the market actually found a direction to break down below, signal from a technical standpoint further downside direction, and then a rate hike pointing to the same way, making us pretty substantial profits. Of course, we can see that this sideways direction continued just before our technicals after Christmas signaled upward direction, which is in this case, and we're still aiming for our third target, which is at a level 66, and that is pretty much around that peak just before that rate hike, making it 100% retracement from that $38.40 decline. So if you are among those that are receiving our daily recommendations about market conditions, you probably saw that we have recommended not recommended, but from educational standpoint, of course, we saw the market possibly moving higher when it breaks above the 1137 channel, because it's been in a sideways direction between these two levels, 1127 and 1137. When it broke above, we saw solid support around the moving averages, and we can see that 21 here, as it's one of the most important at this particular case scenario, is standing intact. Therefore, so far our profits are roughly about $23. So that's in about 17 sessions. Okay, when you calculate 17 sessions multiplied by 4 and then divided by 12, you can see that's 5.5 days of trading. So for about a week time, we've been on a positive side on the gold prices. We've hit 2 targets. Both of them actually hit in one day, yesterday evening. And we're aiming for the 1166 level, which I think it's standing around 65, because 66 is the resistance here. Okay, so I suppose it was about 66.54, so we're lacking about $2.2 to achieve our third target. The same stands for oil prices. Our outlook was for a further upside above the 53.7 level. So far, the market is sustaining levels above that critical level, as I mentioned. That's about 70 cents on the dollar here. Just about that much to break that resistance on that peak here. Okay, to deliver our profits close to that $55 a barrel, which is roughly $1.50. And we know calculations are clear. $1.50 on one lot is $1,500 of profit. But that remains to be seen. However, most of the office, of course, is taking off in about a few hours because the trading day is concluded. Most of the account managers here would take a leave of absence because of the new year. Myself will be also dedicated to my family for the rest of the holidays. Therefore, we're going to be seeing each other next week from the 3rd of January 2017. We would be working in the office full force, of course, clicking on all cylinders as usual. And from then on, after the first week, you will be able to start signing up for the new webinars of the new year of 2017. We will continue with some additional systems that could prove useful to you. So if you're interested, of course, sign up for the full month of webinars with new topics. And of course, if you're interested in something different, if you need to develop a trading plan or a trading system, or you need any other type of assistance, please call us at our telephone lines, or just go to our website. On the right bottom side, you will see a pop-up chat where our support department would kindly answer all of your questions. And if they're not able to do so, they will directly link us to you, and we'll be, of course, at your assistance as soon as possible. That's all for today. Thank you very much for joining us. I hope you've enjoyed this month of webinars. It was very important for you to know, if you still don't know, of course, about what the markets could look like for the first quarter of 2017. And we will continue with the same thematics in the beginning of January. That's all for now. I'll see you next year. Happy New Year. See you then. Bye-bye.